I enjoy coming to work every day knowing that clients are depending on me to guide them through whatever financial needs they have.
Every client we have is different. And so it's really about finding out what's really the most important thing per client.
With financial planning, everything is interconnected. So a comprehensive plan means that you're taking care of income needs now, income needs in the intermediate term, and income needs long term. We'll do an asset cycle portfolio. We'll do a riskalyze test. We'll do a life insurance audit or a life insurance review.
And so when we build a deep relationship with our clients, then we can take a step back and then we can look at different options to help them specifically get to their goals. One of the things I feel our job is as advisors is to introduce strategies to clients that maybe they did not know that they were out there. But it's our our job to come out and say, have you ever thought about this?
And the planning it's not always about income, but a lot of it is also about the legacy. So the element of family is very important to us, and it's important to our clients.
Welcome to Financially Speaking with Jeff Bush. My name is Steve Jablonski and I'm the host for today's show. Today's topic is tax planning, and while this time of year many advisors talk about year-end tax strategies, today we're going to be discussing strategies that you can implement throughout the year. So with that said, Jeff?
Well, hello Steve, welcome to the show. It's good to be here. Always great to be here on PCTV. It's nice to be in the studios right here at Pottstown High School, and of course our show has been broadcast here on the local cable now for 4 years. This is our 5th year actually, and of course we were able to be on the World Wide Web and on our website. So it's so the PCTV website is thepctvnetwork.com. So anyway, it's great to be here. Welcome to the show.
Good. Jeff, recently the team has been in the news. So
we've had this year actually we've had the good fortune of being featured in a lot of segments of the news media. I was featured in I wrote an article for the Reading Eagle. I was interviewed for the U.S. News and World Report. I believe you were featured in the Norristown Patch.
Yep.
Barry wrote an article for Investopedia and Yahoo News. So it's all good exposure. It's all good, in addition to all the things we do out on the road, with our seminars. Barry wrote a book. We do the TV, so it's all good ways for us to get our information out there.
Good. And Jeff, why don't we'll get started with probably a plan and an investment that a lot of people have today in the country, a 401k. Thoughts on that?
Yeah, so the 401k is probably one of the greatest financial innovations of our time. If you're working for a company and they offer a 401k, you'd be a fool not to participate. You can put your money in a tax-favored fashion. So a traditional 401k, you're putting money in, you're getting a tax break. So you put in, let's say you put $100 into your 401k. That $100 comes right off of the calculation of your taxes. A lot of times the company that you're working for is going to offer some kind of a match. That's free money. So if you have a 401k, take advantage of it. And really, it's a great way to build wealth and to build savings for retirement. As Americans, we don't save enough money. And this is a way to save money and build wealth one paycheck at a time.
Yeah. And so that it's pre-tax, but then how does that grow?
Yeah, so it's and by the way, I think I should probably mention what the contribution limits are on the 401k. So, because it's going to change in 2018, it's going to be $18,500. Okay, and if you are over the age of 50, there's what they call a catch-up provision. And the catch-up provision is another $6,000. So that's $24,500. You can put up to $24,500 into a 401k. So when you put money in the 401k, and when we say the word 401k, it also applies to if you're working in the public sector, the 403bs. The rules are very similar. When you put money into a traditional 401k, the money's growing tax deferred.
Okay.
Okay, so you get a tax break going in. All the money grows tax deferred, and then then you pay the tax when you start to pull the money out. And there's rules about taking money out of a 401k. You know, a lot of times what people will do will roll it over into a IRA, yeah. So there's no tax implications of that. And then when you take the money out of either account, whether it's a 401k or an IRA, it's taxable at that point.
And recently, in the last few years, didn't they also introduce that you could do a Roth 401k?
Yeah, so the Roth 401k, I think, was a great addition to the package. Yeah, that was done back in the Tax Act back in 2010, where they expanded so now not only can you have a Roth IRA, but you can have a Roth 401k, so you can and my experience has been most employers have adopted that and have included the Roth as part of the 401k. So the Roth 401k works just like the Roth IRA insofar as you're putting money in on an after-tax basis. So you don't get that tax break up front, but everything grows tax-free once you put the money in the Roth 401k. That's really a very effective way not only to plan for retirement, but also to start to build your legacy. If you're building tax-free dollars, those tax-free dollars last over the course of your lifetime. If you're married, over the course of your spouse's lifetime, and then if you have children, you can pass that money on to them. And if you name them as the beneficiary, they're going to get that money tax-free also, and it'll be tax-free over the course of their lifetime. They just have to take a required minimum distribution from that account, but basically you're building tax-free growth over 2 generations.
Oh, that's
very
great.
Very powerful.
Now let's say that you don't have the availability of a 401k. Talk a little bit about IRAs and what are some of the options.
Yeah, so not everybody has the good fortune of working for a company that has a 401k. So you can do an IRA. All right, so the IRAs have opened up a little bit. So insofar as how much you can contribute, so you have your traditional IRA, and you have your Roth IRA, and both of those, the contribution limit is $5,500 a year, and if you're over the age of 50, a $1,000 per year catch-up provision, so $6,500 if you're over the age of 50.
Okay. And what about if you're a small business owner?
Well, if you're a small business owner, you can open up like a SEP IRA, and a SEP IRA is really it's like an IRA, but the contribution limits are not restricted the way I just described, yeah. The 5,500 plus 1,000. It's based on the earnings of the business. So you could put up to like 25% of yeah. of your income into a SEP IRA.
Yeah, it seems like the government is adding different options more.
Well, they are, and they really have to, because the company pension is really becoming a dinosaur.
Yep.
You know, it's not it used to be if you worked for a large organization. I know when I started my career, I worked for a company that offered a pension. But those, when I say a pension, I mean you retire in a defined, like what we consider a defined benefit program, where you retire, and based on your years of service and some formula of function of your salary, you get a pension check every month, and that lasts for the rest of your life. Well, those pension benefits are really going by the wayside, and now, and I always stress this in our practice, is that you have to be in control of your own finances, your own retirement. So these retirement vehicles are very effective for that. The IRAs, the 401ks, the SEP IRAs, all effective.
And with the 401k and the traditional IRA, the government gives you a tax break year in and year, the year that you contribute. Do they eventually get their money, the government?
Yeah, so what the government is simply doing with these plans is they're deferring.
Yeah.
It's all deferred. So when you put money into an IRA, you get a tax break, but you're essentially just, you're kicking the can down the road, because you're going to pay those taxes when you take your distribution. And and hopefully it's for you and for the government, it's going to be a distribution on a larger amount.
Yeah.
And that's when the taxes are going to become due and payable. And then what happens if you die and you're holding an IRA?
Yeah.
Well, at that point, whoever inherits the IRA inherits the tax liability that goes along with it.
Yeah.
So if it's your spouse, there's a spousal IRA. Your IRA becomes your spouse's IRA, and your spouse then will have to pay the tax on the distribution of the IRA, and then you name your children, and that's an inherited IRA, and then they pay tax on the distribution as well.
And what happens if you did a really good job saving outside of your IRA and you don't need the money?
If you don't need the money in your IRA,
when does the government get their
Yeah, well, what happens, Steve, is at age 70 and 1/2. Okay, 70 and 1/2. You have to take a required minimum distribution, or what we refer to as an RMD.
Yep.
So when we throw that term around, RMD, that means that you're now 70 and a half, and you're required to take a minimum distribution. So there's a table that the IRS uses. It's called the Uniform Lifetime Table. And the Uniform Lifetime Table calls for you to take out a certain amount based on life expectancy, and it gets increasingly larger every year, because you're getting older every year, and you're getting closer to the end. You're getting closer to mortality. And because of that, you have to take out a minimum distribution and pay taxes on it.
And are you pretty much helpless at that point, or is there any strategies that you put
Yeah, and by the
together?
way, I want to circle back to that question, because we were talking about the Roth. There's no required minimum distribution on a Roth IRA, which is really big, because you can just save that money on a tax-free basis for your lifetime. So the RMD only applies to a traditional IRA or a traditional 401k, because that's where the tax liability comes in.
Yeah.
Yeah. What was your next question?
Was there strategies that you can kind of combat the distributions to have people have more money?
Well, yeah, so there's a couple different things you can do. I mean, if you don't need the money, you can always take it and invest it in an after-tax investment vehicle. There's also charitable ways you can make contributions. So, for example, if you're 70 and a half and you're charitably inclined, you can have who's ever holding your IRA assuming that they'll do this. And our experience has been most custodians will do this. They'll say, if you have them send the check directly to the charity, then you get a tax write-off on that.
Right.
So it's a good way. It's a good way to satisfy the charity and get a little bit of a tax break at the same time. If you don't need the don't need the RMD to spend, right?
And it doesn't really count as income at that point.
It doesn't count as taxable income. Yeah, you get a deduction or a tax break on that.
Which is great.
Yeah.
Which is great. As far as charities and gifting, what other types of strategies are out there, like a donor, or what other ways that you can get money to people?
Well, there's a couple different strategies that we use in our practice with respect to charities. So you can set up a donor advised fund.
Yep.
Okay, so with a donor advised fund, basically it's a hybrid of an investment and a charity at the same time. So you set up this donor advised fund and you make the contribution to this donor advised fund, and you get a tax break right away. Okay, so let's say you want to put $10,000 into a donor advised fund. Boom, you get a $10,000 deduction right away, and it sits in this donor advised fund, which allows you to get this tax break. Then you make the contributions to the charity right from that donor advised fund.
Wow. So if you had like a big year in income, maybe it was more than usual, you can just open one of these up and it helps you out, and then you can later on you can.
Yeah. So it's December.
Okay. Yeah.
And you don't know exactly what charities you want to benefit, but you know that at some point you want to benefit some charities, and you want to take the deduction in this year. So you write a check to the donor advised fund, you get the deduction, and then you can make contributions from that donor advised fund as you see fit.
Okay.
Very powerful.
Good.
I mean, the other thing that I'll say, which I think is really big, is life insurance. Okay. And you can do a lot of things with life insurance. You can set up charitable remainder trusts, or what we call CRTs, and you can do that through life insurance, as far as paying the premium into the life insurance, that kind of thing. Or you can just out and out make the charity a benefactor of your life insurance policy.
Yeah, and a lot of times people think that you have to be very, very rich to use life insurance to leverage money, but you can actually, as you don't have to be very, very wealthy to pass tax-free money.
Yeah, it's not just for the wealthy. I mean, it's just we do this for everyday people. The middle class. It's because people are charitably minded, and I mean, if you're healthy and a lot of people are very passionate about certain charities, whether it's their church, or whether it's it could be a number of things, the Salvation Army, or food banks. I mean, we could sit here and name a million charities, but people are passionate about these charities, and it's a good way to get money to them. Like what better way when you die? I mean, it's your legacy. Colleges and universities is another one, where people are very passionate about their their colleges. Sure. Whether whatever college it is, they're passionate about it. And of course, people get inundated with mail. I know I do. You're always getting mail from the alma mater, and they want a donation and everything. So these charities will be more than happy to take your money, whether it's during your lifetime or upon your death. So there's a lot of different strategies, whether it's the donor advised fund, whether it's a charitable remainder trust, whether it's life insurance. There's a lot of different ways.
Yeah. Now let's take a little sidestep here, and let's a topic that's been out in the public a lot has been healthcare. So what types of strategies are there that are beneficial to the everyday person?
Yeah, so what's been popular of late is the HSAs, or health savings accounts. So we can take a minute to talk about the health savings account. So what a health savings account is, Steve, it's a way, if you're in a high deductible plan, okay, so in a high deductible plan means that there's you're paying the first, $2,500, let's say, first $5,000 of whatever your out-of-pocket health care is for the year. So that's a lot of money. So what you can do is set up these savings accounts to pay those costs, and you can set them up in a tax-advantaged way.
Okay.
So a lot of times you're paying that, and it's through payroll deduction a lot of times, and sometimes the company will contribute to those accounts as well. Whether they'll match or they'll put some dollar amount in, and these numbers are changing for 2018. If you're an individual, it's $3,450. If you're a family, it's $6,900. So you can put up to those amounts into a health savings account, and they're all set to go up a little bit in 2018. And I guess the one disclosure that I should say is, there's a lot of changes that are coming in tax legislation. So we're just kind of, as we tape this today, late in 2018, we're given numbers as we know them today. So they're all subject to change and subject to approval by our legislators. But that's pretty powerful that you can put money away in these health savings accounts, and it'll pay for not only your those expenses up to your deductible, but it'll also take care of other things like some over-the-counter medication that you're taking, eyewear, dental, psychiatric care. Like, it really covers a lot of things. And the other thing that I like about it, especially when you compare it to the FSA, which is a flexible savings account, with the HSA, it's not use it or lose it.
Okay.
Meaning that if you don't spend all the dollars in that account at the end of the year, you can just roll them over into a future year. Okay, so I mean, $6,900 is maybe a lot of money. Like people might be apprehensive to say, well, gee, I don't really want to put that much in my account, because what happens if I don't spend it? Just roll it over to the next year, and then what happens is you get a tax break on that. It's a great thing. And then if you die with one of these accounts, your spouse can inherit the account and use it, for your spouse. So as long as those expenses are used, they're medically related, then it's tax-free money.
In a lot of meetings, we get questions about, it's a question mark when people retire, how much going to cost for health care. So isn't this another tool that if you continue to save and you don't use it, that would help after you retire?
Yeah, it's a great tool. It's a great tool, and I would say it's an underutilized tool. It's really not something that is talked about enough, I don't think, and certainly not used enough by consumers, because I think that there's maybe, I don't know if there's like a misunderstanding, but it's just not a well-publicized thing. So here we are, we're getting that information out here today, and we're talking about it. And by the way, I should say this too, Steve. For anybody out there that's watching our show, if you want more information on all this stuff, give our office a call and set up an appointment with us. So you can, we're putting that information right up there on the screen. You can send me an email, info@informedfamily.com. Give us a call. Our phone number's up on the screen, 610-630-4495. We'd be happy to sit down with you. Actually, we'll sit down with you free of charge. We're not going to charge you for, an initial consultation to go over this stuff. And we might be able to, give you some things that you haven't really thought about. Because when you're one thing that we really emphasize in our practice is you're in control of your own retirement. Our job as advisors is to help our clients have a safe and a healthy and a long, prosperous retirement. But ultimately, you're in control of that. You make all the decisions. We help you make those decisions. But we want to educate our clients and help them make the best decisions possible.
And what's your philosophy on planning first?
Well, planning, you plan first and you invest second.
Okay.
So, sometimes people come in with a list of stuff, a lot of different accounts, assets, so on and so forth, and really no meaningful plan.
Yep.
So the planning is really critical. So all these things we're talking about today, tax planning is important, and of course there's a lot of other planning, income planning, legacy planning. Those are all important elements of the plan, and those are all things that that we can help with in our practice.
And what events does Informed Family have coming up?
Yeah, so we take our show on the road. We're not just here in the studio, Steve. Putting it on for PCTV here. We're going to be at the Jeffersonville Golf Club coming up in January 23rd. So for tickets, just give our office a call, and we'll be happy to get those out to you. But we generally do a show, or I should say a workshop, public type workshop every month.
And what's the topic again?
Well, on that one, we're going to talk about planning for Social Security. Okay. So it's an income type workshop where we talk about the proper way to claim your Social Security benefit, and then as that relates to proper income planning and retirement.
Okay. Before we wrap up, any final words?
Well, I would just say that this is a good year to take a good fresh look at your tax strategies. It's sometimes there's maybe some things out there that you haven't thought about before that can benefit you as you start to plan to do your taxes. Take advantage of all the things that the IRS has given to you with respect to your IRAs and your 401ks, and really take advantage of what's offered to you, and I think that is a good way to kick off 2018. So with that being said, this is Financially Speaking with Jeff Bush.